Welcome to the deep dive. You've sent over a really fascinating stack of sources, and today, well, we're diving into something that touches all of us, money.
Yep. It's everywhere, isn't it?
Yep.
Something we think about, worry about, but maybe don't always fully get.
Exactly. And the big takeaway from these sources, the thing that really jumps out, is that doing well with money, it's actually got surprisingly little to do with how smart you are.
Right. It's much, much more about how you behave.
Yeah, less about your IQ score, more about your temperament, maybe.
Precisely. The material makes this great point. We tend to treat money like it's physics. Fixed laws, formulas,
Yeah.
EMC-aki kind of thinking.
Right. Plug in the numbers, get the right answer.
But the sources argue it's way more like psychology. It's full of emotions, quirks, our personal histories. It's messy. Human.
Okay, so that's the core idea we're exploring in this deep dive, using your sources. We're looking at why we do the things we do with money, often things that seem, well, a bit strange from the outside. What can simple stories teach us?
And the first big contrast the sources draw is exactly that point. Behavior beating brain power.
Yeah, that opening story is something else. This super intelligent executive, right? Apparently he just lost it in a hotel restaurant, smashed a lamp. And when they told him it'd cost $500 to replace, he didn't just pay. He pulls out this huge wad of cash, like $5,000.
Right.
Throws it down and basically says, "Here, take it, get lost, don't insult me." Just pure impulse.
And, well, maybe not surprisingly, that kind of behavior didn't end well financially. The sources say he went broke later on.
Yeah, makes sense. But then you contrast him with Ronald Reed.
Ah, yes. Ronald Reed,
Mm-hmm.
the janitor and gas station attendant.
Right. An ordinary guy, worked manual jobs his whole life, first in his family to finish high school, apparently had a hitchhike to get there.
But quietly, patiently, he built up a fortune. Ended up leaving millions to charity when he died.
It's incredible. It just perfectly illustrates the point. Someone with basic behavioral skills, patience, discipline, not panicking, can absolutely crush someone brilliant who lacks emotional control.
Exactly. Knowing what you should do is one thing, but knowing what's going on in your own head when you try to actually do it, especially under pressure, that's the real game changer.
That's the crux of it. And this behavior thing, it's tied so tightly to our own pasts, isn't it?
Oh, absolutely. Our personal history with money is huge. The sources really emphasize this.
Everyone's got a unique story starting from when they were kids, and these experiences just carve out completely different views of how money works.
There's that study they mentioned, Momendier and Nagel, found that how much risk you're willing to take. It's not really about how smart you are or your education level.
No. What is it then?
It heavily depends on the economic times you personally live through, your lived experience.
Okay, give us some examples from the material. How does that play out?
Well, think about someone who grew up genuinely poor, like struggling for basics. Compare that to the child of a wealthy banker. Their whole outlook on risk, security, opportunity. It's going to be fundamentally different, right?
Really different worlds.
Or inflation. Someone who came of age in the 70s, watching crisis just go nuts, they'll feel differently about saving, about debt, than someone born in the 90s when prices were mostly stable.
Or the stockbroker wiped out in the Great Depression versus, I don't know, a tech worker in the dot-com boom.
Exactly. Or Australians, the sources mentioned, who haven't had a recession in like 30 years, versus Americans who've seen several big ones.
Right.
And the sources put this number on it, which is kind of mind-blowing. Your personal experience, even if it's like a tiny, tiny sliver of world history,
Yeah.
it can make up something like 80% of how you think the financial world works. Your own little slice dictates most of your worldview.
Wow. That explains a lot. It explains why people can look at the same facts and come to totally opposite conclusions about the market or whatever.
And it explains behaviors that seem crazy from the outside, like lottery tickets.
Yeah, the lottery ticket example is powerful. Americans spend, more on lottery tickets than movies, games, music, sports, and books combined.
That's the stat. It's huge.
And it's disproportionately lower income households buying them, right? Spending hundreds a year, often when they don't even have emergency savings.
On the surface, it looks completely irrational. Why throw money away on those odds when you need it for rent?
But
the sources suggest, looking at it from their perspective, if you're stuck paycheck to paycheck, saving feels impossible. Getting ahead feels impossible. All the stuff others take for granted, vacations, a reliable car, college for the kids without crushing debt, it feels totally out of reach.
So the lottery ticket isn't just throwing money away.
For some, it might be the only tangible way to buy a shot, however tiny, at accessing that good life. You're buying hope, a dream. It might not be rational by textbook standards, but from inside that situation, maybe it feels reasonable.
That reframing makes a huge difference. And it connects to another point, how incredibly new a lot of our modern financial world actually is.
Oh, definitely. We take so much for granted, but the infrastructure is really recent.
Like, the whole idea that everyone should be saving for a dignified retirement, that's pretty modern. The 401k, born in 1978.
Barely yesterday.
And the Roth IRA, 1998. These things are younger than a lot of the people relying on them.
Exactly. So for something as complex and emotional as money, the main tools we have are still basically teenagers. We're all kind of learning this game as we go.
Which might explain some of the seemingly crazy stuff people do. They're navigating brand new systems with, well, not much historical context to guide them personally.
Right. And on top of behavior and history and new systems, you've got these massive forces completely outside our control. Luck and risk.
Yes. The great unquantifiables.
They have such a huge impact on outcomes no matter how smart or diligent you are. But boy, are they hard for us to really grapple with.
Why is that? Why do we struggle so much to accept the role of luck or risk?
Well, think about it. Saying someone else got lucky sounds kind of petty, like you're jealous. Saying you got lucky can feel like it diminishes your own hard work.
Yeah, that makes sense.
And failure. It's just easier, cleaner to blame bad decisions. Saying you failed because of bad luck or risk feels messy, like an excuse. We like neat stories.
The sources give some good examples, like Bill Gates and Ken Evans, two brilliant kids, similar drive, but tragedy struck one. Was it just bad luck?
Or Cornelius Vanderbilt blatantly breaking the law and saying, ain't I got the power?
Right.
Was that bold genius or reckless risk-taking? The outcome often decides how we label it, looking back.
Right. The line is so thin.
Even Benjamin Graham, the investing legend, a huge chunk of his firm's success came from one stock, Geico. He even admitted holding so much of it violated his own diversification rules.
So was it luck or genius?
He himself wondered, one lucky break or one supremely shrewd decision, can we tell them apart? Often you just can't.
Okay, so if it's not all about our choices, and luck and risk are swirling around, this leads to that key distinction the sources make between getting money and keeping it.
Yes. And if you have to sum up long-term financial success in one word, the sources suggest that word is survival.
Survival. Because the real engine of wealth is compounding, right? That slow, almost invisible growth that builds on itself.
Like planting an oak tree. You barely see anything for years, then it starts to take shape. But the real magic happens over decades. 50 years, 70 years.
But for that oak tree to get huge, it has to survive droughts, storms, pests, everything life throws at it.
Exactly. You have to survive the market crashes, the recessions, the personal setbacks, long enough for compounding to work. Sequoia Capital, a big VC firm, their secret, we've always been afraid of going out of business.
Only the paranoid survive. It's not about hitting home runs every year.
No, it's about staying in the game. Look at Warren Buffett. His genius isn't necessarily having the highest annual returns. Jim Simons at Renaissance did way better year to year.
But Buffett's been doing it since he was practically a kid, for an incredibly long time.
That's the key. The sources say something like 99.9% of his wealth came after age 50. Longevity is his superpower. That wild calculation, if Simons had Buffett's lifespan, it's like $63 quintillion or something absurd.
Which obviously wouldn't happen, but it makes the point dramatically. Time in the market, fueled by survival, beats timing the market.
Survival is the edge. Which brings us naturally to the idea of enough.
Ah, yes. The moving goalpost. The endless comparison game.
There's always someone richer, right? The ball player envies the hedge fund guy who envies Buffett, who maybe looks at Bezos. It never ends.
So if you're playing that comparison game, you literally can't win. The ceiling just keeps rising.
Exactly. The only way off that hamster wheel is to define enough for yourself.
There's that great Kurt Vonnegut story in the sources. He's at a party with Joseph Heller, who wrote Catch-22.
Yeah.
And Vonnegut points out that their billionaire host probably made more money that day than Heller earned from Catch-22 in its entire history.
Oof. What did Heller say?
He just replies, yes, but I have something he will never have enough.
Wow. Simple. Powerful.
But the drive for more can be dangerous. The sources use the example of Rajat Gupta.
Yeah, tragic story. Already worth, what, $100 million? An insane amount of money.
Enough by any sane standard. But apparently, he wanted to be a billionaire. So while on the board of Goldman Sachs, he got involved in insider trading around that big Buffett deal.
And ended up in prison. Risked everything he had, everything he needed, The money, reputation, freedom for something he absolutely did not need. More.
It's not just illegal stuff either. Long-term capital management in '98, brilliant Nobel laureates. They blew up spectacularly, risking what they had for more they didn't need.
That relentless pursuit of more just pushes people towards regret. Burnout, breaking rules, losing perspective.
So if chasing more is a trap and finding enough is the goal, what's the real benefit of money then? The sources argue its highest dividend is control over your time.
This might be the most valuable thing money can buy. Freedom, autonomy. Waking up and knowing you decide what your day looks like.
There's that psychology research mentioned, Angus Campbell, finding that a sense of control over your life predicts happiness better than your income level or how fancy your job title is.
Exactly. Money buys that control piece by piece. Having savings means you can handle a car repair without panicking. More savings means you can maybe take time off between jobs. Enough means you might not have to work a job you hate.
The author's personal story really hits this home. Choosing between a high-paying finance internship,
where the boss basically says, your weekends belong to me.
yeah, total lack of control, versus being a musician barely scraping by but having complete control over his time. He said the banking job made him miserable despite the money.
And later, even after selling a company and having more money, the biggest change wasn't the dollar amount. It was cementing that independence, that control over his own life and time. That's the real wealth.
It's kind of ironic then, isn't it? America's way wealthier now, materially, than in the 50s. We have more stuff. But are people happier? Do they feel more in control of their time? Maybe not.
Especially with thinking jobs. The sources make a good point contrasting with manual labor. Rockefeller's job was thinking, making decisions. That kind of work follows you home. It's never really off.
Like so many jobs today, you might leave the office, but the work is still buzzing in your head. It feels like you're always on call. Money can buy you freedom from that constant mental load.
And yet, so much of our culture pushes us towards the exact opposite of time control. Showing off what we spend. Conspicuous consumption.
Right. The big paradox, wealth is what you don't see.
It's the car not bought, the upgrade skipped, the money saved and invested quietly. It's hidden potential.
That valet parking anecdote is perfect. You see the flash of car, you think, wow, rich owner.
But you're seeing the spending, not the wealth. For all you know, that car payment eats up half their income. You see the car, not the bank balance or the debt.
And the deeper irony. People chase wealth often because they want admiration.
Right. Respect.
But spending it on flashy things doesn't usually get you admiration for you. It mostly just makes other people think about their own desire for similar stuff.
The sources argue things like humility, kindness, empathy. Those earn respect far more effectively than a fancy watch.
True wealth is invisible. Like Ronald Reed, the janitor, nobody knew he was wealthy until he died. You can't learn saving by watching someone not spend.
Exactly. So building wealth. It's less about income, less even about amazing investment returns, and much more about your savings rate, how much you manage not to spend. It's the gap.
Wealth is the accumulation of money you resisted spending today, so you have more options tomorrow.
Well put. And making those choices often involves being reasonable rather than strictly rational, another key distinction from the sources.
I could define those terms again. Rational versus reasonable.
Rational is pure logic. Numbers, data, spreadsheets, what makes sense mathematically. Reasonable is, well, what works for a real human being in the messy real world. It accounts for emotions, comfort, regret, peace of mind.
And the argument is, sometimes reasonable is actually better.
Often, yes. Take Harry Markowitz, Nobel Prize winner in economics, Mr. Portfolio Theory himself. How did he invest his own money? 50-50 stocks and bonds. Not because some complex model said that was optimal for returns, but because, he said, it minimized his potential future regret. He knew himself. That's reasonable, even if maybe not perfectly rational on paper.
I get it. A perfectly rational strategy is useless if you can't actually stick with it when things get scary.
Exactly. The sources use the example of leverage. Maybe mathematically, using leverage boosts long-term expected returns. But imagine getting wiped out by a crash. The purely rational advice might be, okay, reload, do it again, the math works.
But no normal person could do that. The emotional toll would be immense. That's not reasonable.
Right. Or other things mentioned, like home bias. Investing mostly in your own country. Not strictly rational, you miss global diversification. But reasonable. Maybe. If it helps you feel more comfortable and stay invested.
Or making small speculative bets.
Yeah, maybe not rational for your core portfolio, but reasonable if it scratches an itch and keeps you from gambling with the serious money.
Even Jack Bogle, Mr. Low-Cost Index Fund, invested in his son's higher-fee active fund.
Totally irrational by his own gospel. But reasonable for his son, absolutely. Investing has feelings involved. It's not just numbers. Sometimes you choose between being happy and being right.
That makes so much sense. It's about what works for you. So thinking about guidance, can we just look at history as a map?
History is incredibly valuable. The sources stress that. For understanding risks, for seeing patterns of behavior, for knowing what can happen. But a precise map for the future? No. Too much changes.
The historians as prophets fallacy, they call it. Assuming the past perfectly predicts the future. Maybe in geology, but finance. It evolves.
Think about those structural changes. 401ks, Roth IRAs, the whole venture capital world financing startups. These are new. Data from before they existed doesn't fully capture today's reality.
Even Benjamin Graham kept changing his formulas. He knew what worked in the 30s wasn't quite right by the 70s. The game changed.
Right. So that whole debate, is it different this time? It's tricky. Assuming nothing changes is just as dangerous as assuming everything changes. History gives us context, not coordinates.
And it often doesn't prepare us for the big, unexpected shocks, the tail events.
Exactly. World wars, pandemics, 9/11,
Yeah.
things that come out of nowhere and have massive compounding consequences nobody predicted using past data.
Daniel Kahneman's point. The lesson from surprises isn't, I won't make that mistake again. It's, wow, the world is really hard to predict.
The real lesson is that the world is surprising. Which is funny because despite all the progress and unpredictability, we seem weirdly drawn to pessimism, especially about money.
Yeah, that Deirdre McCloskey quote. For reasons I have never understood, people like to hear that the world is going to hell. Why is pessimism so appealing?
Well, it often sounds smarter, doesn't it?
Yeah.
Serious. Predicting doom seems more intellectually rigorous than predicting things will generally muddle through and get better. Pessimism gets more attention.
And optimism isn't about thinking everything will be perfect.
No, the sources define it as believing the odds of a good outcome are in your favor over time, despite setbacks. It's a bet on progress, on people generally trying to improve things.
But pessimism grabs headlines. The sources mention that crazy prediction someone got published in the Wall Street Journal of the U.S. breaking into 6 pieces by 2010.
Right. Pure doom-mongering. Compare that to the quiet, stunning, compounding recovery of Japan after WWII. Progress is often slow and boring. Collapse is dramatic.
And financial pessimism is especially easy, isn't it? Because money affects everyone, and losses often happen fast.
Exactly. A market crash is sudden. A job loss is sudden. It's easier to build a story around that than around the slow, incremental gains of technology or medicine that happen over decades. Loss is a better story.
Speaking of stories, that brings us to how we construct narratives about money in history.
We're wired for it. Even babies create stories to make sense of things, like why dad left the room. We need explanations.
And when we look at history or even current events, we tend to pick the evidence that fits the story we already believe or the one that supports our tribe.
Confirmation bias, yeah.
Yeah.
And in finance, where the stakes feel so high, we're really vulnerable to plausible-sounding stories, even if the evidence is thin. Think about confident pundits on TV or, Bernie Madoff.
Yeah.
His story sounded good for a long time.
Which brings us back again to needing that room for error, right? As a hedge against buying into a good story that turns out wrong.
Absolutely. Flexibility, not being all in on one narrative, is crucial. And related to that is the end of history illusion.
Daniel Gildert's idea. We're pretty good at seeing how much we've changed in the past, but we consistently underestimate how much will change in the future.
Yeah, we think our current values, goals, preferences are pretty much set, but they're not. This means making super rigid, extreme, long-term plans can lead to regret later when you're a different person.
So avoiding the extremes in your financial plan gives your future self some breathing room.
Exactly. It accommodates the person you haven't met yet, you 10 or 20 years from now.
Okay, so if success isn't about being the smartest or perfectly predicting the future or avoiding all risk, what's the actual price we pay for doing well over time?
The sources frame this so well. It's not a fine you pay for doing something wrong. It's an admission fee.
The cost of entry. And that fee is?
Volatility, fear, doubt, uncertainty, regret. All those uncomfortable feelings you experience when markets go crazy or things don't go as planned.
That's the price of admission for earning long-term market returns.
Precisely. You can accept it and pay it, understanding it's part of the deal. Or you can try to avoid paying it, like companies trying to smooth earnings or hide risk, like GE under Welch or Fannie and Freddie.
But trying to dodge the fee usually ends up costing you way more down the road, doesn't it? Crisis, collapse.
It catches up with you, often painfully. And that ties into bubbles, too. The sources suggest bubbles aren't just irrationality.
No. What else is going on?
It's often people playing different games. Someone chasing short-term momentum isn't thinking about long-term value. Their game has different rules. Their actions might seem crazy to a long-term investor, but make sense within their short-term time frame.
Like conspicuous spending, it's a different game than wealth building. Different goals, different rules.
Exactly. Different time horizons, different objectives.
Okay, let's try to pull this all together. Based on all these behavioral insights, what are some of the core practical takeaways from the sources?
Yeah, they offer some great grounded advice. First, less ego, more wealth. Saving is basically the space between your ego and your income. Manage the ego, saving happens.
Good one.
Be okay with lots of things going wrong. Because of tail events, most individual bets won't be massive winners. Focus on the overall portfolio surviving and thriving.
Okay.
Use your money to get control over your time. That's its greatest value.
The highest dividend.
Right. Be nicer, less flashy. Respect comes more from how you treat people than what you own.
Simple but true.
Just save. Period. Not just for goals, but for the surprises, the unknowns life throws at you.
Define the price of success, that admission fee of volatility, and be willing to pay it.
Yeah, accept it. Don't try to avoid it. And worship room for error. It's not just being cautious. It's the critical thing that allows compounding to happen over the long haul. It's an actual advantage.
And finally, avoid the extreme ends of financial planning. Give your future self flexibility.
Minimize future regret.
Those are fantastic principles. And the sources back them up with some personal examples, right? Choices that were maybe reasonable over purely rational.
Yeah, like the author deciding to keep their lifestyle pretty much the same even when income went up, the goalposts didn't move. That automatically creates a high savings rate without feeling like painful sacrifice.
Or paying off the mortgage early, even though mathematically maybe leveraging it would produce higher returns.
Right. Or holding a decent chunk of assets, like 20% in cash. Highly irrational according to some models that say you should be fully invested.
But the reason was?
Peace of mind. Knowing they'd never be forced to sell stocks during a downturn just to cover living expenses or an emergency. That cash buys endurance, buys the ability to let the investments compound without interruption.
And crucially, these aren't presented as everyone must do this.
No, not at all. They're examples of what worked for that person,
Yeah.
aligning their finances with their psychology, their tolerance for risk, their life goals. It's about finding your reasonable path.
That's key. Finally, the sources wrap up with this really interesting historical overview to explain maybe why we feel the way we do about money today.
Yeah, it paints a picture starting after World War II. You had this unique convergence. A marriage boom, lingering fears of depression, low interest rates, and deliberate government policy pushing people to consume and take on debt.
Plus, all that pent-up demand from the war years and a huge boom in productivity.
It created this massive economic expansion, and importantly, the benefits were shared pretty widely. The poor got less poor, the gap between rich and poor narrowed significantly.
And lifestyles started looking more similar across classes, right? Same kinds of cars, TVs, appliances.
A kind of mass middle-class experience emerged. But then around the 70s, things started to shift. Growth continued, but it became much more uneven.
Inequality took off. The top 1% saw huge income gains, while the bottom, 99%, not so much. Stagnation for many.
But here's the kicker. The cultural expectation of living a similar lifestyle to your peers, that expectation born in the more equal post-war era, that persisted. People still felt they should have the same kind of house, car, vacation as people whose incomes were now pulling away rapidly.
So how did they bridge that gap between stagnant incomes and rising expectations?
Debt. The big stretch, the sources call it. Mortgages got bigger. Credit card debt exploded. Car loans, student loans. People borrowed heavily to try and maintain a lifestyle that felt normal based on the past, but was increasingly out of reach based on their current economic reality.
That context explains so much about the financial anxiety so many people feel today. They're trying to live up to an old script in a new economic reality defined by much greater inequality.
Exactly. The feeling that the system isn't working for them, the desire for big changes. It makes a lot more sense when you see that historical disconnect between expectations and reality.
So after diving deep into all this, we really come back to that central idea. Doing well with money, it seems, is so much less about fancy math.
And so much more about understanding ourselves,
Hmm.
our behaviors, our biases, the stories we tell ourselves, all shaped by our unique path through history.
It's about playing the long game, focusing on survival, finding enough, and valuing time and flexibility. Simple ideas, but incredibly hard to execute consistently.
Because we're human,
Mm.
emotional historical creatures navigating systems that are often newer and stranger than we realize.
Which leaves us with a final thought for you, the listener. Given everything we've discussed, how deeply your personal history shapes your financial worldview, how much luck and risk are involved, how quickly the world can change.
How much of what you believe about money, about risk, about saving, about the future, is grounded in objective truth versus your own specific, limited, maybe even outdated experience.
And just asking that question, acknowledging that distinction, how might that help you make more reasonable, more resilient decisions for your own financial life going forward?
Something to chew on. It's less about finding the single right answer and more about understanding your own psychology within the bigger picture.
A fantastic journey through these sources. Thanks so much for digging into them with us. It's given us all a lot to think about.